Welcome, everyone. My guest today is Mike Simonsen, president of Altos Research, to talk about the two big housing market trends to watch in 2025. Mike, welcome back to the podcast.
Always great to be here, Sarah.
Great to have you on, especially as we're starting 2025 and you are watching this housing market coming up very closely. And so I really wanted to talk about an article that you wrote in December, at the end of December, about the two big housing market trends to watch in 2025. And those two are affordability and sellers in the market. So let's jump in and talk about affordability.
Yeah, well, it's no secret that we have an affordability crisis in the country. Home prices went way up compared to incomes, especially during the pandemic, but really over the last 15 years. And even when the demand came way down, mortgage rates went up, home prices didn't come down. So now we have a double whammy on affordability. We have home prices that went up, and we have the cost of money that went up. So mortgage rates went up. And so, and as we roll into January here, there's no sign of that subsiding really anywhere. There are a few markets, maybe more than a few, that have especially across the South, Texas, Florida, some of the Sun Belt markets that have a lot more inventory. Inventory really built as demand fell over the last couple of years. And so home prices are flat or they're down. Some of them are down. And depending on how you measure them, that there are home prices. Some markets haven't even found the bottom yet, like still declining. So there are some parts of the country where home prices are down, but they're not down 30% or something to get them back to affordable. And in those markets, especially if you're looking at the Florida markets, we have the additional cost of things like insurance costs. So affordability gets a triple whammy in some of those places. So as we look at 2025, there's no sign of that really abating in any dramatic way. And that will, be a cloud over the housing market for the whole year.
Yeah, it's just crazy. At the same time, we've seen some signs that demand is picking up. So I think that that's interesting. Also, one of the things you pointed out in your article is that we are at the highest mortgage payment for home buyers, starting this year at the highest ever, which is surprising to me.
Yeah, so mortgage payments are a function of the cost of the house and the cost of the mortgage. And so, when we have mortgage rates have surged back over 7%. And there have been moments in the past 2 years when they were like 7.5% or almost 8%. But 7% at the beginning, over 7% at the beginning of the years is significantly higher. It's at the high end of the range that we've been at for the last 3 years. And the median price of homes is up 4% over a year ago. And so the payments that we're making are at their highest. And so like affordability as measured by payments, can get better during the year if mortgage rates fall back down into the sixes. That's great. We saw in the September, October time when mortgage rates came down close to 6, that for just momentarily that stirred demand. It was suddenly payments were 10 or 12 or 15% more cheaper than they had been just months earlier.
What do you see when you look at the other data that shows you that affordability is getting hit? What are the other metrics that you see? Is it like time to sell a house, or what does it look like?
Well, it's really, you can see it in the demand metrics. So, for example, as mortgage rates most of last year were in the upper 6s or over 7, we didn't see any demand pickup. Even as rates eased down to about 6.5%, there was the needle didn't move in terms of people who were like getting ready to buy the house. But when it got closer to 6%, suddenly there were a few more people. We could see transaction volume pick up. Overall, we can see the time on market is slower. It's about 20% more days, 20% longer to sell a house now than a year ago. And that was obviously longer than the year before that. So the time to sell homes is climbing. So all of those are the big demand metrics that we can track across, a bunch of areas.
Well, let's talk about inventory, because that has such an effect, and that's actually a better story this year than we've seen in the last couple years. But maybe for the reasons that you're talking about, not for great reasons.
Yeah. So inventory is really the expression of the other trend for 2025, which is, are we finally seeing more sellers entering the market? And you can track supply by the total number of homes on the market. That's active inventory, but you can also track it by the new listings each week. How many new sellers are entering the market? And so inventory can build if we have very few sellers, but even fewer buyers, inventory will build. And in the post-pandemic era, the defining characteristic has been how few people want to sell their house. We've got cheap mortgages. We're not changing jobs. We're not moving. We're like staying here. I'm not selling my house. I'm not. And so very few new listings each week. And you and Logan talk about the new listings data all the time. It's been very low, but in 24, it's been climbing. It's about 8 or 10% more sellers each week than a year prior. And so in 25, I think we'll see that growth as well. So another 10% more sellers each week. And these are folks who maybe, have been delaying their purchase or their move for a couple of years. And now it's fine. Like now we've got 2 kids and it's time to move. Those kind of things inch back into the market. They were like a shadow supply of people who were really holding off. And so the reason that's the important trend to watch for this year, 25, is that if the sellers move faster than the buyers, we could get a more significant increase in inventory. So inventory rose by 27% over last year. We expect it to rise by another maybe 15% in 25. But it could be, what if it's 20 or 25% more? Like that could then have impact on prices, because now there's a lot more homes for sale than there is demand. So that's why I'm looking at that. In general, I think more sellers is a good thing. It means more supply for more options for buyers. It means less, even if, prices aren't coming down, it's less upward pressure on prices. So, your another year with flat prices means your income grows, and that helps affordability. So in general, we want to get back to an old normal levels of inventory of sellers each week. Those sellers are buyers, so that means more transactions are happening. All of those things are in general healthy, but it could be a signal of getting out of balance. And getting out of balance means you end up would be a thing where you have a big price correction, and we haven't had any signals of a big price correction, in almost 20 years now. So that's something that we want to keep our eyes on.
So maybe, just summarize for us too, because not every listener maybe knows the way that you look at inventory, the way that you guys are tracking it versus say, maybe they're used to looking at the NAR inventory or something like that. How does Altos look at that?
So at Altos Research, we track every home for sale in the country every week. And we can track the new listings, and we can track the price of the new listings, and we can track the ones that went into contract and the price of those. So there's all this rich signal in the active market. And the way NAR traditionally tracks is they look backwards right now it's January. They'll be looking backwards at December and say how many houses were on the market at any point in December and call that inventory. In fact, at any given moment, there's a lot fewer homes than that, because if a house is on the market now and it gets an offer this Friday, it's not an active inventory next week. Yeah, you can't buy it because it's already in a sales process. And so, but NAR, when they look backwards at January, they will count that as active inventory. So the Altos inventory is at any given moment. Right now there is 635,000 single family homes unsold on the market around the US. Like, that's it. That's the choice you get. It is 27% more than a year ago, but it's still fewer than the pre-pandemic times. And so that's how we watch that, and why we watch the active inventory. Like, there's so much signal in where prices are going. And for example, one of the things right now we can see is sales have been increasing by about 5 or 6 or 7% over 2023, over a year ago, through December. And as of right now, there are about 5% more homes in the contract pending stage than a year ago. So those homes will close in January, and we can see that that there are 5% more of them. So there's likely to be about 5% more sales that close in January. So a little bit of sales growth over a year ago. Now, the challenge, though, is that we also track the newly pendings each week. And in December, and we talked about this in this week's Altos data, is in December, we're showing no growth and the weekly sales numbers over a year ago. And so there's a few things going on, one of which is that the holidays, Christmas and New Year's, were like on Wednesday, so it like kind of destroys 2 full weeks. So it's a little tricky to see, but the other things happened, of course, is that mortgage rates are higher, and they're over 7%. And so then, is this a function of buyers just waiting? So, 5% or there have been a few more buyers in the market in the fall that we've been tracking every week since about September. But now in December, in the weekly readings, those seem to have kind of evaporated. Now we'll get, it'll be a little more clear in January. As January progresses, we have fewer holidays mucking things up, and so it'll be a little more clear. But that's something to keep our eyes on. Like, has the sales momentum that we've seen in the last few months, which, in the NAR, when they look backwards at the previous months, the headlines are now reporting the same things we've been reporting weekly for several months now. And the headlines have caught up. So, they're about 3 months. But if we roll through January and mortgage rates stay in the 7s through January, we could see a scenario where sales do not pick up and they're suddenly flat. And then now the headlines will be behind again because they won't see home sales flat until February or March.
I think that's so fascinating. So we're having our Housing Economic Summit February 26th. You're speaking, and what you're speaking on is the housing data signals people should be watching to know what's going to happen with the housing market. So it's exactly what you're talking about now, and how the data can lead you there. So when you look at that, I think I've talked with Logan about how it's pretty unusual to see those pendings going higher starting in November and December. If you look back historically, it's happened the last couple of years. And this to me is really, really wild. What do you make of that?
I think that post-pandemic, post-2020, we lost some seasonality in the real estate market. Part of that was during the pandemic, we were just buying everything, and we just kept on buying right through November and December. We used to have big seasonal swings in the fall. Inventory would peak in July and then start ticking down in the second half of the year. Now inventory doesn't really peak until October or even November. And so then there's a little bit of seasonal decline. And so, there are some of those factors where the cost of money was super cheap, therefore we were buying. It slowed very down. And then last year, mortgage rates peaked in October, November, and then started coming down, and that actually spurred some activity late in the year. And so the timing of mortgage rate peaks it also goes into that relative effect. Like people are sensitive. They'll happily delay. Buyers will happily delay a purchase for a couple of months to see if money gets cheaper.
It's true. And I do think the whole idea of seasonality, like to your point on mortgage rates, in the period running up to 2020, I mean, mortgage rates changed so little over a year's time frame. You know what I mean? Like if we had a point, 50 BPS one way or the other, it was kind of a big deal. Which seems like incredible now looking back on it because we've had such volatile rates. So I do think that makes sense how that can sway things, because otherwise it's like we tend to think of housing kind of following the school year. You know what I mean? People are looking in the spring so that they can get in the summer so that the kids can start in the fall. And it feels like, well, that couldn't have changed, right? I mean, that part of it does not change. So what are the other variables?
Yeah, and so that part of it even changed a little bit, and maybe changing more. But yeah, there's still some of that seasonality in there. And in fact, you're talking about the wide range of mortgage rate, in the year. And one of the fascinating things is when rates are at 4%, if they move 50 basis points, that's kind of a big deal. In the past few years, rates have moved like 220 basis points, 150 basis points. And in fact, we think for 2025, we expect, we could have as much as 150 basis point move in rates within the year. And the HousingWire forecast is, a high end of the range is 7.25. We're in January. We're kind of pushing that right now. And as Logan mentioned yesterday about the jobs data, like pushing mortgage rates higher, like we're pushing that. And if we're lucky, we get some of the right economic news at the right time. The 10-year falls during the year, and we get some compression on spreads. If we're lucky, maybe during the year we inch under 6%, and we get some borrowers get a chance to refi if you have the window timed, or buyers get to act really quickly. If we're lucky, that happens. And so that's what we're looking at. And I think when we look at other forecasters for 2025, it's pretty conventional wisdom that there is nothing in the cards to get rates below 6% for any substantial amount of time. A year ago, there were still people holding out for 5% mortgage rates by the end of 2024. All of that optimism, or hopium is gone now. And so it's pretty conventional to see people in 6%. I think, even a few months ago, it was rare to see anybody forecasting above 7%. When we actually announced our forecast and saying, like, we think rates could be above 7% for part of the year. And it was pretty rare to see forecasters do that. Some of those forecasters, it's handy go, 6 to 7 is about where it will be. And that's largely right. But almost none of them had a 7 handle. And we thought there could indeed be. So suddenly, we're in January with mortgage rates in the 7s and no sign yet of them easing. We're looking at that and like those kind of combinations, a little bit stronger inflation numbers, a little bit stronger jobs data. The Fed doesn't cut opts not to cut. The 10-year drives higher. Like all of those factors could keep our mortgage rates, in the 7s or certainly in the 6s for the year.
Props to you for that. So this is the first time that we've had Logan's done a mortgage rate forecast. We've had other things. You've done stuff. This is the first time we've had a HousingWire housing market forecast, which included all sorts of things, including mortgage rates. And so I thought it was really interesting. And obviously we do have the advantage of some very recent data on all these things, right? This is the Altos advantage that we see, is that like you said, you can see things coming in the data before other people can do it. So then you wrote a very interesting story that said all those mortgage forecasts are already wrong because not ours, but like all the 2025 mortgage in the span of a week, we were publishing, this is what this person said, this person, and then it was all out the window. It was so sad.
Yeah, it was because very few people were looking at 7s
Right.
Rates in the sevens for 2025. So all their expectations were in the sixes, and we were already in the sevens rolling into 2025. So, wrong was a nice headline term, but they very few people in those forecasts said, hey, there's a possibility that we spend some of the year in the sevens. Now, I am still optimistic that we're at the high end of the range for the year, that we get some good economic data. We're lucky. We get some lucky economic data that brings rates down, trades in the sixes for most of the year. And if we're really lucky, it drops to the low sixes like it did in September briefly, or maybe even dips under. Logan points out that the spreads have been compressing. And as there's less volatility, the spreads will continue to compress. So that's, will help mortgage rates for most of the year. And so I remain optimistic that that's the case. But that's really why we wrote that. I wrote that piece on like all those mortgage rate forecasts are already wrong, because a year ago, so many of those folks would say rates are going to be in the fives. Right. And, we never even got close to that. Or we barely got close to that for the year. And I think that was worth pointing out.
I do too. And I think everybody would rather have we all wish in housing, we all wish mortgage rates could go down, not for any bad reasons, but just, not because we're in some, recession and everyone's, hurting, but just that like we've been in this really tight space in the housing market. It's been 4 years now. Like we're ready for a break here, or at least the last 2 years, you could say, last 2.5 years.
2.5 years.
But at the same time, when we have those kind of like forecasts like we did last year, it's almost worse, because I feel like for the last 2 years, we've been like, okay, it's just around the bend. We're going to come. And like the disappointment of that, and also trying to plan a business around that, super hard.
Yes. And that's exactly right. And it's plan a business around it. It is, that back to that affordability topic where we started the conversation, like it's really hard. And it's hard for all kinds of folks throughout the ecosystem. And so it would be nice to have rates come back down again. We'll report it when it happens.
We will. Mike, thanks so much for being on. Looking forward to you. Would encourage all of our listeners, sign up for that Housing Economics Summit. You're going to bring it. Really excited about your session, about looking at which of the signals you need to look at to know where the housing market's headed, what those signals are telling you, what's just noise that you don't have to listen to. So it's going to be great. And I appreciate you being on.
Yeah, that Housing Economics Summit at the end of February in Dallas. That'll be terrific.
Can't wait to see you then. All right.
See you there.